Hey kids, welcome to the Market Message. I'm Bill Valentine, here to make you a better investor. We're going to talk about stocks in a global context in just a second, but let's start with a look, as we do every month, at the 5 major asset classes for the year so far through the end of May. So on a year-to-date basis, bonds down a little bit. That's what happens when interest rates rise. The same thing applies to REITs, which had a nice month as rates stalled a little bit, but on a year-to-date basis, real estate investment trusts down 2.7%. Commodities, look at that, the leading asset class. That has not been the case for most of the last 6 years. Commodities up 8.5%. U.S. stocks up a smidge, 1.2%. Foreign stocks down 1.8%, and that leads me to today's discussion. If you've watched a few of these videos, you know that for the last couple of years I have been favoring foreign stocks relative to the U.S. That doesn't mean I'm not invested in the U.S. stock market. It just means that if you look at it from an opportunity set, on a market cap weighted basis, the U.S. market makes up almost 50% of the global equity opportunity set. So foreign stocks, be the developed countries in Europe or in Asia or the emerging fast-growing markets, collectively make up about half of the opportunity set. If you were sort of globally neutral, you didn't know which region of the world would do best, you'd probably do about 50% in the US, you'd probably do about 30% in Europe, 20% in developed Asia, and 10% in emerging markets. But we've been skewed heavily to foreign stocks for the last couple of years, and that was going well for a little while. And then in December of 2017, the president announced a major tax cut to the profits on corporate earnings, and as a result, the U.S. stock market has seen a bit of a resurgence and a drop in valuation. Let's take a look at that in a few charts that I pulled out for you that tell the story even better. So the first one that we're looking at here is the major global equity market groups that I just referred to on a year-to-date basis. The black line is the S&P 500, a measure of U.S. stocks. Up a couple of percent, as we said, on a year-to-date basis. With dividends added in, it's about a 3% gainer for the year. Asian stocks are in blue. They're about flat for the year. European stocks down a little bit, about 1%. That's the sort of the tan line, and then the red line, or the auburn line, is down about 4%, representative of emerging markets. Brazil, Russia, India, China, Latin America, Eastern Europe. These countries tend to be more trade dependent, and all the rumblings about trade tariffs have put a little bit of a damper on emerging market stocks. That's not really the story today. What I want to talk to you about today is whether the thesis about foreign stocks still holds, and how we should look at stocks globally. I'm still a strong proponent of being invested in every major geographic and developed versus emerging part of the world. I still am leaning heavily towards foreign at about 2-to-1 versus the U.S. But here's the reason why that the dominance of foreign over the U.S. after just having gotten going over the last couple of years has stalled out. This is a look at a bar chart of earnings per share guidance on a company-by-company basis. When companies come out and they increase their earnings per share guidance, they're counted along the axis on the left. So basically what you're seeing is now for 2018, December through basically the first quarter, you saw over 120 companies upwardly revise their earnings per share guidance. And again, that's entirely a function, or largely a function, of the tax cuts, but also a strong economy. So this has clearly been a boon to earnings to have this tax cut. And as a result, on this next chart, you're seeing it affect the forward PE ratio. The PE ratio is the price to earnings ratio. It's a broad way to kind of value the aggregate U.S. stock market. And if you use forward earnings, you're taking the price of the S&P 500 today versus its combined projected earnings. And of course, because projected earnings have spiked on the back of the tax cut, you've seen that drop on the far right side of the chart. Where the forward PE was once 20, it's now slightly below average at about 16.5. So what's the point here? There's a few points. One, stocks are still strong globally. They won't be forever, but it's harder to pick a top. than it is to continue to go along for the ride. The second thing is the relative outperformance of the U.S. compared to foreign stock markets this year, albeit very small, has been largely explained by this one-time tax cut. It's good for corporations in the United States. It's good for earnings globally. A lot of the large companies in the S&P 500 do business globally, and so the more money they have, the more money they're putting back into overseas operations. So it's fundamentally been a good thing. It's why the U.S. stock market's not way ahead of foreign stocks. I still believe the story over the next 5 years will see foreign stocks do well, and in fact probably eclipse the U.S. by a slight basis up until the point in time in which we reach the recession. When is that going to happen? We don't know. Right now, based on the last couple of videos you may have seen of mine, you know that I'm bullish going forward, so I continue to advocate for a reasonably aggressive equity position, a globally diversified one, and if you want to lean a little bit more in the direction of trying to sort of beat the global average, you would lean foreign, but that's just what I'm doing and not necessarily instructions on what you should do. I hope that you've seen some interesting information today that helps you in your investing, and we'll see you back here real soon with the market message. I'm Bill Valentine. Thanks so much for watching.